Welcome back, my friends. If you follow this channel or the general news about the oil industry, you will know about the recent actions of OPEC+. In late October, OPEC+, the powerful oil cartel, has just surprised the world with an unexpected cut in production. That sent oil markets reeling and oil prices higher. OPEC+ considered the production cut to be necessary because of recession fears. And because COVID lockdowns in China were slowing oil imports from that country. Of course, that was the exact opposite of what the United States was hoping OPEC+ would do. And, if you recall, that was at a time just prior to the midterm elections in the United States. So, the White House was doing everything it could to keep gasoline prices low. By now, the midterm elections have come and gone. But the United States government is still interested in keeping gas prices low. That is because lower gasoline prices are better for economic activity levels in the United States. But today, we are hearing that OPEC+ is considering further production cuts. And that is sure to be a lightning rod when it comes to geopolitics. The OPEC+ meeting will convene on Sunday to decide on the next phase of production policy. This scheduled meeting will determine whether there will be another production cut. The highly anticipated meeting comes ahead of potentially disruptive price cap on Russian oil. It also comes as oil demand in China is weakening due to COVID lockdowns and mounting fears of a worldwide recession. European countries are deeply concerned about what will happen to energy prices this winter, and the prospect of an economic recession and possibly even a winter gas shortage. What does this mean for consumers? What does this mean for energy markets? What does this mean for oil companies? What does it mean for the US economy? And what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. OPEC+ is now signaling that it might impose further oil output cuts on Sunday. The Energy Alliance is weighing the impact of a pending ban on Russia's crude exports and a possible price cap on Russian oil, said one oil industry analysts. OPEC+ is a group of 23 oil exporting countries. Saudi Arabia is seen as the informal head country of OPEC+. The influential group will convene on Sunday in a Zoom call. The purpose of the meeting is to decide on the next phase of oil production policy. The highly anticipated meeting comes ahead of potentially disruptive sanctions on Russian oil, weakening crude demand in China and mounting fears of a recession. I believe that OPEC+ would be better off to stay the course, Claudio Galimberti, Senior Vice President of Analysis at energy consultancy Rystad. That means they should roll over existing production policy, Galimberti continued. OPEC+ has been rumored to consider a cut on the basis of demand weakness, specifically in China, over the past few days, Galimberti said. Yet, China's traffic nationwide is not down dramatically, Galimberti also said. Energy buyers and sellers are extremely nervous about the European Union's sanctions on Russian oil. Russian seaborne crude oil exports are subject to a price cap of $60 per barrel starting on December 5. That is a huge source of uncertainty. The European Union agreed to ban the purchase of Russian seaborne crude oil starting on December 5. The ban is part of an all-out effort to cut Russia's war chest after Russia invaded Ukraine. Some experts are concerned that an outright ban on Russian crude imports could send oil prices higher. But it seems that the G7 nations have agreed on a price cap on the amount it will pay for Russian oil. The other factor OPEC will need to consider is indeed the price cap, Galimberti said. This adds to the uncertainty, Galimberti also noted. The Kremlin said that any price cap on Russian oil will cause more harm than good. OPEC+ voted to reduce production by 2 million barrels per day starting in November. But, since that price cap went into effect, crude oil prices have generally fallen. The production cut came despite calls from the US for OPEC+ to pump more crude oil. The White House wants higher crude oil production to lower fuel prices and help the global economy. But OPEC+ responded by saying that it could impose deeper output cuts. That is because OPEC+ wants to spur a recovery in crude oil prices. Actually, the Wall Street Journal reported that OPEC+ might increase oil production by 500,000 barrels per day. So, I guess that we will all have to wait until Sunday to hear what OPEC+ actually decides. There was no expectation of a production increase from the upcoming OPEC+ meeting and a significant chance of a deeper output cut, said RBC Capital Markets' Helly McCroft. There is so much uncertainty, Croft said. OPEC delegates have to factor in what happens with China but also what happens with Russian production, Croft continued. It came out today that Sunday's meeting will be held virtually, instead of in person. I think OPEC will opt for no-drama optics, which seemingly increases the likelihood of a rollover decision, continued Croft. And the term rollover decision means that production will stay the same with no change. Irrespective of whether the group chooses to stay the course or cut deeper, we expect key ministers to signal a willingness to meet quickly to address any major change in market conditions that may be arising in the coming weeks and months, Croft said in the note. Oil prices have fallen quite a lot from their high point in June. If you follow this channel or the oil markets in general, you will know that there are two main oil price benchmarks. There is international Brent crude, the international standard price, mainly traded in London. That is often referred to simply as Brent. Then, there is the U.S. standard benchmark called West Texas Intermediate. That is referred to as WTI or sometimes just U.S. oil. Actually, many countries have their own country benchmark, but those are the two most often quoted. International Brent crude futures a little lower at $87.78 a barrel on Friday morning in London. Brent has traded in the $90 plus levels for most of the past 2 or 3 months. And, of course, it is down from over $123 in early June. U.S. West Texas Intermediate futures traded at $80.95 today. And that is down from a level of $122 6 months ago. Barring any negative surprise during Sunday's virtual OPEC Plus talks and assuming a healthy compromise on Russian oil price cap before the EU sanctions kick in on Monday, it is tempting to audaciously conclude that the bottom has been found, Thomas Varga, analyst at broker PVM Oil Associates, said in a note Thursday. Oil prices trading below $90 a barrel was not acceptable for OPEC Plus, Varga said. Russia is widely expected to introduce retaliatory measures against those signing up for the G7 deal, Varga continued. Choppy and nervous market conditions will prevail, but the new month should bring more joy than November, he added. And, when Varga says joy, he means that he expects crude oil prices to generally go higher in December. Varga clearly thinks that OPEC Plus will do whatever it can to keep Brent crude oil prices above $90 per barrel. OPEC ministers would need to discuss whether to accommodate further weakness in demand in China, said Jeff Curry, global head of commodities at Goldman Sachs. They got to deal with the fact that, hey, demand is down in China, prices are reflecting it, Curry continued. And do they accommodate that weakness in demand? Said Curry. I think there is a high probability that we do see a production cut, he added. Lower oil prices heighten the risk of a new OPEC Plus output cut, said an oil analyst from the Eurasia Group. Ultimately, the decision will depend on the trajectory of the oil price when OPEC Plus meets, Eurasia Group analysts led by Rod Al-Qadiri said Monday in a research note. And how much disruption is evident in markets because of the EU sanctions, Al-Qadiri continued. If Brent crude futures dip below $80 a barrel for a sustained period ahead of the meeting, OPEC Plus leaders could push for another production cut to shore up prices and bring Brent futures back up to around $90. A level that they appear to favor, Al-Qadiri also said. So, add all of that up and it seems as though the so-called experts and industry analysts do not really know exactly what to expect on Sunday. But, the general consensus is that OPEC Plus is expected to try to adjust production to keep Brent crude trading at $90 per barrel. And, West Texas Intermediate U.S. oil generally trades $6 to $8 lower than Brent crude oil. And, I would say that is somewhat higher than the White House would like. The White House would prefer West Texas Intermediate to be in the range of $70 to $75 per barrel. For those of you not familiar, OPEC Plus includes Saudi Arabia, Russia, Iran, Iraq, Algeria, Nigeria, and other oil-producing nations. It does not include the United States or Canada, two of the world's largest oil-producing countries. Oil prices have been falling for weeks now, and the group is trying to spur a recovery in crude oil prices. All of this is despite calls from U.S. President Joe Biden asking the cartel to increase oil production. And the group agreed to cut production by 2 million barrels per day starting in November. Energy analysts point out that it is difficult for anyone to predict oil prices 2 months in advance these days. The future of the economy and energy prices are highly uncertain as more European sanctions on Russia are added. These sanctions affect shipping insurance, price caps and limits on petroleum imports. Oil prices have been on a roller coaster ride in 2022. prices reached a 2-year high in March. But oil prices fell 25% between the middle of June and the end of August. The price decline has been driven by the expectation that interest rate hikes by the U.S. Federal Reserve would reduce demand for gasoline. The average price of gasoline in the U.S. reached a peak of $5.02 per gallon on June 14th. But, what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.